We entered 2026 with markets in a fairly confident mood. Expectations were that central banks across the world would continue along an interest rate cutting path, with inflation pressures having receded and allowing for an easing of monetary policy that would be supportive of a fairly robust backdrop for economic growth. This was reflected by strong gains across equities and bonds during January and February, as we saw the continuation of the theme that had emerged in the latter part of 2025, whereby markets across Europe, Asia, and some of the emerging markets had shown outperformance of US equities, driven in part by a more challenging outlook for the US dollar. Nonetheless, this was set against a backdrop of a far more aggressive US foreign policy stance, as the so-called Donroe Doctrine was being used to justify US military action in Venezuela and put pressure on NATO ally Denmark over the sovereignty of Greenland. And any complacency that markets might have had about the geopolitical risk outlook was shattered in March when the US began its military action aimed at achieving regime change in Iran. The market reaction was immediate. The initial reaction function during periods of elevated geopolitical risk is for market participants to raise cash in the global reserve currency. This strengthens the US dollar and therefore benefits US dollar assets relative to those priced in local currencies. Gold, despite its perception as a safe haven asset, fell as holders took profits to lock in those gains that had been made over the previous months. Oil has, of course, spiked significantly on fears of extended supply disruption, and for countries outside of the US, which is now a net energy exporter, this acts as a double squeeze, as the combination of the higher oil price and local currency weakness can be particularly painful. Stock markets in countries which are large net energy importers, such as Japan and Korea, those countries that have energy-dependent industrial economies, such as Germany, and countries with higher rates of inflation, such as ourselves here in the United Kingdom, have seen sharp changes in sentiment and experienced significant drawdowns. The previous outlook for inflation has been completely upended, and bond markets have moved to price in interest rate rises, which have in turn led to a downgrade of economic growth assumptions and caused heavy losses across a wide range of asset classes. Other than oil and energy-related equities, there have been very few places to hide out, so to speak, and portfolios fell during March by between 3 and 7%, wiping out all of those gains made in January and February, and that leaves a first quarter return of between negative 0.5% and negative 2% across low-risk through to high-risk portfolios. We entered this period of volatility with a neutral weighting to equities, a medium risk portfolio having around 60% exposure, a short duration bias within fixed income, which has been somewhat beneficial given long dated bond prices have fallen by considerably more than short dated bonds, and positions within absolute return and defined return funds, which have acted as diversifiers. Our Asset Allocation Committee have convened twice since the outbreak of the war, emphasizing that periods of heightened volatility may create opportunities to rebalance selectively rather than prompting asset allocation-driven changes in our positioning. Our MPS doesn't have fixed rebalance schedules, so we are able to act and adjust portfolios once there is greater clarity on the duration of the war, conscious that any news of an end to hostilities would likely spark a sharp relief rally before a full assessment of what has fundamentally changed. Our full MPS quarterly report will be published shortly, and myself and the multi-asset team here at Brooks Macdonald are always pleased to handle any questions, so please do get in touch.